To understand global wealth, you have to look at the machines that move it. A modern cargo ship requires 40,000 tons of specialized steel, an engine 4 stories tall, and a price tag easily pushing $150 million. That is more money than a brand new airliner crashing through the waves. When you see a massive vessel like this, you naturally look at the typography on the side of the hull. You might assume Maersk, MSC, or CMA CGM owns that ship. In reality, the operator moving your cargo is rarely the one holding the deed. The actual owners of the global merchant fleet belong to a much quieter club. We're talking about secretive Greek family offices, which control roughly a fifth of all the world's ships, along with Japanese leasing conglomerates and private equity firms operating out of London or New York. These magnates do not hold their fleets under one giant corporate umbrella. Instead, they use a legal shield called a Special Purpose Vehicle, or SPV. If an owner has 50 ships, they create 50 completely separate shoal companies. One company, one ship. To distance themselves further, they register these isolated companies in specific nations, places like Panama, the Marshall Islands, or Liberia. If one vessel goes hopelessly bankrupt or spills oil, the rest of the billionaire's fleet is insulated from the legal fallout. Welcome to Jahazi, where we track exactly how the world's money moves. For centuries, traditional shipping has operated as an impenetrable club for the ultra-wealthy, but the walls protecting that club are starting to crack. The physical vessels carrying 90% of the items you buy are highly insulated, risk-averse financial instruments, engineered specifically to protect and grow generational wealth. The families and equity firms owning these vessels do not care how a shipment of electronics gets from Shenzhen to Los Angeles. To them, a ship is simply a high-stakes rental property. They lease these ships out using a few different models. In a time charter, an operator pays a fixed daily rate, say $40,000 a day for 3 years, while the owner maintains the vessel and crew. In a bareboat charter, the operator handles absolutely everything, and the owner simply collects a smaller monthly check with near zero involvement. Then there is the spot market. Here, ships are rented voyage by voyage. Daily rates swing wildly based on seasonal demand, sudden economic booms, or unexpected geopolitical crises. When the Ever Given wedged itself sideways across the Suez Canal in 2021, halting global trade, spot rates went parabolic. Ships that usually rented for $15,000 a day were suddenly commanding $150,000 a day. Owners minted massive fortunes in a matter of months. To even sit at this table requires immense capital. Almost nobody pays $150 million in cash. The standard financial structure relies on 30% upfront equity, with massive maritime banks providing the remaining 70% as a loan secured against the vessel itself. If the shipping market crashes and the resale value of that hull drops below the debt owed, the owner is suddenly underwater. The collateral is worth less than the loan. If the bank demands cash, the entire fleet can be seized. This combination, 9-figure upfront costs, wild market volatility, and heavy bank leverage, is exactly what has kept everyday investors completely locked out of this asset class. Now, specialized platforms like ShipFinex are attempting to bypass those maritime banks entirely, using blockchain technology to break that financial barrier to entry. The process relies on fractionalization. Instead of one billionaire buying the entire special purpose vehicle, that isolated shell company owning the ship is divided up. The SPV is converted into thousands of digital tokens, each representing a share of the asset. Because these tokens live on a decentralized public ledger, they bypass the need for a massive, centralized bank loan. Anyone can verify exactly who owns what fraction of the ship directly on the chain. By removing the institutional middlemen, the minimum buy-in collapses. Retail investors can purchase a token and gain direct financial exposure to a working maritime asset for as little as $1,000. By converting the SPV into digital tokens, a highly illiquid piece of industrial machinery becomes a fluid, accessible security. Once you own a fraction of a ship, the process is incredibly transparent. Token holders can plug into live tracking APIs to monitor their specific vessel's location, speed, and cargo type in real time as it crosses the ocean. As that ship completes voyages, its daily freight earnings steadily accumulate on the blockchain. Following a quarterly audit, those profits are distributed directly back to the token holders as digital dividends. And because these shares are tokenized, the investment remains entirely liquid. You can instantly sell your tokens on a secondary exchange,
or even spend your digital dividend payouts globally using a linked virtual Visa card.
But buying a piece of a cargo ship carries serious exposure. Shipping is notoriously cyclical. When global supply chains run smoothly and vessel capacity outpaces demand, daily charter rates collapse, and the value of your tokens will drop right alongside them. There is also strict regulatory risk. The global push to decarbonize means a vessel running on conventional fuel today could suddenly face mandates for expensive green fuels. If a ship becomes too dirty to legally enter major ports, it instantly becomes a stranded asset. Yet, even in worst-case scenarios, these vessels have an absolute financial floor. A ship physically lasts around 25 years. When it reaches the end of its life, it is sailed one last time to a shipbreaking beach. Even completely dead and dismantled, the raw scrap weight of that steel can yield upwards of $15 million. The era where the world's oceans were the exclusive playground of billionaires is coming to a close. The lucrative calculation of maritime risk is finally passing into the hands of the retail market. I'm Jahazi, and if you want to keep tracking how the world's money really moves, make sure to subscribe.